In this video, we will explore about delta hedging. This is a vital concept for managing risk when you are trading options. By the end of this video, you will understand how professional traders use this technique to create what we call a delta neutral portfolio, which helps keep their investments safe from market swings. To grasp this concept, we first need to talk about option delta. Think of delta as a way to measure how sensitive an option's value is to a small change in the price of the stock it belongs to. For example, if a call option has a delta of 0.60, it means that if the stock price goes up by 1 rupee, the price of the option will rise by 0.60 rupees. Traders use this number to figure out exactly how to protect their portfolios. Let us look at a real-world example to see how a portfolio of option positions works. Imagine a stock is trading at 100 rupees. You decide to take a short position by selling 10 at the money call options. In this case, the lot size is 50. If the call delta is 0.50, it means that for every 1 rupee, the stock price changes. The price of your call will change by 50 paise. Now, we must consider the risk of this short call position. Because you have sold these calls, you are at risk if the stock price goes up. Let's imagine a scenario where the stock price rises by 1 rupee. To find your total loss, you take the delta impact of 0.50, multiply it by the lot size of 50, and then multiply that by the 10 contracts you sold. This results in a loss of 250 rupees. To handle this, we need to focus on hedging the risk. Our goal is to find a way to gain money that covers the loss in our option position. The action we take is to go long, which means buying the underlying stock futures. We do this because stock futures have a delta of roughly 1. This is because the price of a futures contract usually moves hand in hand with the actual stock price. To determine the right position size, we need to do a bit of math. We know we need a target gain of 250 rupees. Since each futures contract has a delta of 1 and a lot size of 50, the value we get from one lot is 1 multiplied by 50, which equals 50. By taking our required 250 and dividing it by 50, we find that we need to buy exactly 5 futures contracts. Once we have bought those 5 futures contracts, we have achieved a delta neutral position. You can think of this like a weighing scale. On one side, your short 10 calls have a negative delta of 250. On the other side, your long 5 futures have a positive delta of 250. Together, they balance out to a net delta of 0. This means your total position is now protected and will not be affected by small changes in the stock price. It is very important to remember that this balance is mainly for small changes in the stock price. While being delta neutral keeps you safe during minor market movements, very large price movements can still disrupt this balance. This is why traders must stay alert and keep a close eye on their positions. The reason we have to stay alert is that the option delta itself is always changing. Whenever the price of the underlying stock moves, the delta moves too. For example, if the stock price was 100 rupees with a delta of 0.50 and then it rises to 110 rupees, the call delta might increase to 0.60. When the delta changes like this, your portfolio is no longer balanced. If the delta has risen to 0.60, your current long position of 5 future slots is no longer enough to protect you. The weighing scale has tipped and you are once again exposed to risk because your hedge is not strong enough for the new price level. To manage this risk, you must take action to rebalance your portfolio. In our example, you would increase your long position by buying one more lot. This brings your total to 6 lots of futures. By making this adjustment, you return your portfolio to a delta neutral state, ensuring that you are protected once again. This entire cycle is known as delta hedging. It involves a continuous process of calculating the delta, executing your hedge by buying or selling futures, and then monitoring the market to readjust as needed. This is how professional option traders manage their risks and keep their portfolios stable regardless of which way the market moves.